Hey guys, it's MHFin. In today's video, we'll be going over iron condors, an interesting approach to trading options that allows you to profit when a stock doesn't move. Time decay is your enemy when you're buying calls or puts, but utilizing iron condors, time decay becomes your friend. This popular options trading method involves 4 different contracts. The important distinction that sets it apart from many other strategies is that it's a market neutral strategy, meaning it doesn't matter if it's implemented in a bullish or bearish market, your profit will always be the highest if the underlying stock remains calm and trades within a narrow range. This is the basis of this strategy, and I'll explain this in detail later. Traders love using it because it offers limited risk with a high chance of profitability. Your maximum loss is always well defined, so you'll know beforehand what the worst case scenario will be given a set of circumstances. Instead of explaining the ins and outs behind this strategy, I'll dive right into an example and we'll go from there. Today, we're going to be setting up an iron condor with Apple stock. Apple, at the making of this video, is trading at $187 even. Presently, it's March 20th, and we're going to be purchasing options expiring April 26th, which is a little more than a month away. An iron condor, like I mentioned earlier, requires 4 different contracts, specifically selling one out of the money call, buying an even higher out of the money call, selling an out of the money put, and buying an even lower out of the money put. Let's start with the calls. We first purchase one $205 call option. We then also sell one $202 call option. Then we purchase one $160 put, and finally we sell one $163 put. The combination of these 4 contracts completes the iron condor. Now the question of profit. What needs to happen in order for us to make a profit? Well, like I mentioned earlier, the best case scenario for us is that the stock stays within a narrow range. At expiration, if Apple finishes between $202.80 and $162.20, we are set to make a $32 profit. If the stock finishes outside these 2 numbers, we would suffer a $218 loss. That may not sound like a lot, but understand that for us to suffer a loss, Apple will have to rise or fall about 10% in either direction prior to April 26th. That is quite a range, and the chances of this are relatively low. If it stays anywhere between those 2 numbers, 202.80 and 162.20, we profit. Of course, you can play with the numbers to make it even more risky. By making that range smaller, your potential profits would also increase, but also with the chances that you land outside that range and suffer a significant loss. At the root of it all, an iron condor limits risks while also limiting your profit potential. It's designed to have a large probability of earning a small, limited profit. Fighting time decay is something options traders constantly battle to try to stay ahead of in terms of profit. An iron condor reverses this by making time decay work for us. Let me show you how in this quick demonstration using our example. Remember, when we're selling puts and calls, we are hoping they expire out of the money so we can collect a premium. In our example, we sold $202 call options while also selling a $163 put. We know if the stock stays between these 2 figures, we can collect our premium and be happy. Unfortunately, this position alone will leave us exposed to some serious losses if by any chance the underlying stock were to jump up or down suddenly. To protect from this, we buy the $160 put as well as the $205 call. This acts as sort of an insurance policy, ensuring that if Apple does suddenly jump up or down, we wouldn't suffer catastrophic losses. Although we would still lose money in this scenario, it would limit our max loss to just $218. By looking at the profit loss chart, we can get a better idea. As you can tell from the picture, an iron condor gets its name from the shape you see on your screen. On the y-axis, we have profit and loss, while on the x-axis, we have plotted Apple's price. Our max profit points are as follows. If Apple reaches anywhere between these 2 points, at expiration, we would earn $39. Now look at the ends. You can see once we begin to move away from these 2 points, our profits dwindle down to the break-even points. At these prices, we begin to take on losses. Moving out further, we reach our maximum loss point. If Apple's price goes down past this lower end or the upper end, a max loss will be incurred and we would lose out on $218. If you're choosing to implement this strategy on Robinhood, just make sure you have enough cash in your account to cover the maximum loss associated with that trade. Robinhood will not allow you to place the trade unless they have the collateral requirement filled. Most other trading platforms also make this a requirement. In our example we used earlier with Apple, our maximum loss was $218. This would mean that we would need at least $218 in cash in our account before we could execute the trade. Just in case you lose your bet, Robinhood wants to ensure that you could cover your losses. And remember, you can trade an Iron Condor as a single entity. If you use Robinhood, an Iron Condor will not be shown as 4 different contracts, but as a single options trade. This makes it easier to understand when you're trying to figure out whether or not you're profitable. If you want to get a good idea of how potential profits and losses will look, check out optionscalculator.com. By inputting your parameters, the website will generate a nice chart that will show you what kinds of profits or losses you should expect given a certain date and price. Fair warning that these prices are based on current implied volatility levels and don't take into account future movements. Of course, as you can tell by looking at the chart, your chances of profit are relatively uniform and grow towards the max profit point as the date of expiration draws closer. Time is your friend in this strategy, and the more of it that passes without fluctuations in price, the more you draw closer to your max profit point. This is why it's well advised that if an Iron Condor gets to the point where its profit is close to its max prior to the date of expiration, you should sell it early. Holding the Iron Condor till the end in a scenario where it has already reached a profit close to the max is ill-advised, as time presents unnecessary risk which the underlying asset, which in our case is Apple, can potentially move out of the so-called profit range, causing significant losses if it doesn't return back prior to expiration. Iron Condors can provide consistent low profits that, if played correctly, can generate long-term returns using patience and repeatability. Thank you guys for watching. If you're planning on using Robinhood to trade options or stocks commission-free, please use my affiliate link below. We'll both get a free stock if you sign up and deposit.